Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, April 10th, 2019. In this video, we're going to change gears, do something a little bit different. Just can't bring myself to do another market update when there's absolutely nothing significant to update. Even the 60-minute charts were still above those support levels I've been watching. Same story as the last few videos. We continue to inch a little higher while trading volumes have dropped off pretty noticeably. That's a concern right now. But then price compression we've gone virtually nowhere in the last week or so here. So I'm not going to spend any time or maybe it will touch on a brief overview of the markets because it ties into what I'm going to cover here. So what I'd like to talk about is more of a macro fundamental picture of the economy right now. Just a quick crash course for those of you not familiar with what GDP is, gross domestic product. This is, you can do obviously a Google search anywhere. This is Wikipedia. It's GDP is just here. Let me grab another box tool. It's just simply a measure of all the value of all the final goods and services produced in the U.S. in a period of time, which is GDP is reported quarterly. So every 3 months, the government comes out with the GDP statistics, and a recession is defined as two consecutive negative quarters of GDP growth. Or the opposite of growth, contraction. And now that's the big question: are we going to have a recession this year? Is it going to be next year? Is it down the road? But make no mistake about it: with a recession comes a bear market. The two are hand in hand. And the thing is, a stock market will always lead GDP. GDP, first of all, it's lagged, as I told you. It only comes out, they report it quarterly. Even then, it's about almost a month lag time before they get out the last quarter GDP. And then after that, they usually revise it after the fact to come in and tell you afterwards, oh, well, this actually was lower than we thought. Because when the market's starting to hit those inflection points, when it tops or the economy or bottoms, things can change pretty quickly. So then they go and they make the after the fact revisions. But I guess the takeaway from that is, if you're waiting to hear the government tell you we're in a recession, you're going to be down 20-30% on your 401k and your portfolio by the time you hear it's official. So just know that the stock market tends to lead fundamentals by about 6 to 9 months is usually what they say, and of course that varies. So and this is this came off the Wall Street Journal here, Daily Shot. It's the New York Fed probability of U.S. recession in 12 months, and they labeled it, will it be any different this time? I wish they would have overlaid this or shaded it. Sometimes they'll shade these with recession, show you the recessions, but again, most of you know at least roughly when the big moves in the market were. We had recessions during all these periods. This indicated the probability of recession. This is where we're at right now. This chart, I believe, was published yesterday. If you recall, back in the dot-com bubble, market peaked in 2000. We had a recession. There was another top, and this was again probability of recession. Back here, the market peaked in October of 2007, so that's somewhere right around here. The probability keeps going up because, again, as I said, the stock market will turn down first, then the market. So you're going to see this continue to climb. So these were the market tops, right where we are now. So will this time be any different? I can just tell you this: the masses at the top think it will be different. It's always different that time around. It's called recency bias. Market's strong, stock market's up, everyone's portfolio's up. And again, that's why I'm doing this video. We're going to look at the the two main drivers of consumer confidence, which is home values and your 401k or investment values. And if I didn't mention that already when I was talking about GDP, about roughly two-thirds of GDP is made up, or is attributed to, I should say, consumer spending. So make no mistake about that. The government can print all the money they want. They can boost all kinds of spending programs all they want. When consumer sentiment turns and consumers start tightening up their wallet, that's it. the economy will turn and go down and follow. So we're going to look at that. And again, I'm going to show you the real estate market and everything else. But this chart is, pretty compelling. And it's as you heard that we recently had the yield curve inversion as well, which has been done a near perfect job of signaling impending recessions. Again, there's a lag time there with all this stuff, including the yield curve inversion. So I just wanted to point this one out. And you can also see, I get these sent every day, daily shot from the journal. You can just everything. These are just different, economic indicators, growth and factor orders. It's really about the only thing, and I can scroll through these all day long. Not everything is rolling over. I don't want to say that. The economy is not falling off a cliff or anything like that, but things are rolling over. They're turning down. And about the only thing right now, and I can tell you the only thing buoying this economy is the consumer because of those ultra low unemployment rates near record lows. But I put up a chart a few weeks back. They're right at about where they were at the top of all the other previous economic cycles. They're at that level or a little bit below. This is interesting too. The other thing besides the consumer, with the low unemployment numbers right now, the only other thing that's really kept this market lifted up, especially the big rally off the December lows, was this corporate. We've heard it again. S&P 500 composite buybacks, corporate buybacks, and that's the red line. Usually buybacks are much lower than capital expenditure. CapEx spending is, companies investing in their growth and in their future. This is just, it's a share price manipulation. They're taking the cash from the tax cuts, and you can see the last time that happened, where corporate buybacks outstripped the capital expenditures, or at least started to outpace it like this, and it peaked, was right there, right at the top. That is like to the button. And I put up this chart before that showed months back that showed that corporate buybacks peaked exactly to the very month the stock market peaked back in 2007. So now look, it hasn't peaked yet. This can keep going up. That's the thing. The trend is up. But we know it's high. We know it's outstripping capital expenditures, and that's just not a good thing longer term. That also speaks to just how long and large the next bear market will be, for many reasons there. But again, let's get away from these fundamentals for now. And let's drill down to the consumer, because again, 2/3 of GDP. That's what's driving the economy. It always has. It still is. And so we're going to look at this chart. And before I get into this chart, I did a quick search to just get a chart that shows what I already knew, but I want to show it to you visually. What percentage of our wealth, individuals' wealth, and it varies, of course, by your net worth. Before I get into that, let me just give credit to the source here. This comes from the Visual Capitalist. All right, so this chart was fairly recent. I think they posted this late last year or so. Either way, it's things like this don't change very rapidly. What you can see here, you have the net worth of individuals. So it's tiered right here. This is where most people in the country falls, between the 100,000 and 1 million. The people, with 10,000 net worth, they're young, just starting out, or they're not doing so well financially, and they're for the most part, they're trying to make ends meet. Their car, their vehicle is one of the biggest, percentage of their assets that they have. Whereas they have very little, relatively speaking, to their net worth in pensions and liquid assets and things like that. Liquid assets, by the way, that's just cash, checking account stuff. So really the two drivers here, by far, of consumer spending and consumer confidence is the value of your house and your stock market investments, your retirement, your 401k plan, your IRAs, and stuff like that. And again, we're focusing on this tier. As it's wealth goes up, it becomes a smaller and smaller percentage of it, but it's still a significant amount of wealth. But make no mistake about it, you can see right here the line. This is the percentage right here of somebody's net worth. If they have a net worth of $100,000, by far the bulk is in their primary residence. And even when you get to the $1 million mark there of net worth, it is still the largest component of someone's net worth. So that's why we're going to focus on the real estate market in this video. And And we'll also touch on the stock market because that is the second largest and very significant. And I don't need to tell you that. The stock market goes down, drops 20, 30%, along with your house price, your home value. You've just wiped out, a quarter or more of your net worth. Again, depending on where you sit in here, and that's most people. So these are what we're watching. The stock market, pension, retirement, all that. That's what I do day in and day out. So we've covered that a lot. We'll start there, just a brief overview, and then we'll just drill down to the some of the major real estate markets in the country. That's what I have charts on. We'll go through there. I want to point out a few trends and some things I'm noticing, and really where I think we're at, or where it appears to be. I'll let you guys make your own mind up where we appear to be in the cycle, in the real estate cycle. All right, so go back to the stock market here. Let's start there. Let me grab a chart. All right, so here's the S&P 500. And what's happened, if you can zoom in a little bit here, what I'm going to do is measure out, and again, I've talked about this quite a bit. Almost all the gains from this rally came from the move off the lows on December 26 up to about this point here. In fact, I'm measuring out, taking from the lows to the highs there on February 25th. So that's December 26th through February 25th. That's 2 months. If you look at the pop-up box on the left of the screen, go down towards the bottom. It'll show you 2 months, and in green there, it'll say on the right 20.34%. So 2 months off the lows, we rallied 20%. From that point, which is now we're a month and a half past that point to where we're at today, right now, as I'm doing this video, we're up about 2.3%, and that's a month and a half. So again, here's what it was: 20%. If you were in it and you got most or all of it, great. From that point, last month and a half, 2% in the market. So while the market is certainly bulletproof and does not want to go down, we've had a couple little corrections from there, but it's moved back up, and it is moving up. Now, I'm not going to take that from it. The trend is up, but again, last month and a half, it's up just over 2%. So what does that mean? Well, the trend is up until it's not up, but again, well, just hit on the most salient points of this chart and the weekly chart. We have, as we continue to move up, volumes have been tapering off lately to concerning levels, what I believe are concerning levels, a lot lower than normal. We're seeing the market just lift slightly higher, really about the last week or so. It's sideways trading, you can see there in the last few candles. But the things that stand out, we have that negative divergence. And again, we've only had that a few times. It is rare to see the divergences on the daily chart not play out for a significant trend change. It does happen, however. They are not be-all, end-all, signals, and also they're not sell signals. They're just merely an indication momentum's waning and the trend change is likely. So you still need a sell signal to have these divergences play out in the form of a correction. But I wanted to make clear that they're still there. They're very much intact. Whether we want to go up and punch through and test the old highs from 2018, or maybe even pop above it or not, doesn't matter. They'll still be intact if it happens soon. If it takes a while, we'll see. Those divergences could be taken out. So that is that's really what's been going on lately. And then the bigger picture is this. Let's look at the weekly chart. Here's our bull market uptrend line. It's a pretty clean uptrend line. It's not a lot of, you don't have to force this one. There's the bull market off the 2009 lows, March of 2009. It was broken back in last fall, last winter, in the last quarter. Back tested. We had to move down, and all we've had so far is a kickback rally. And whether or not this proves to be the bull market top, I'll tell you, even if we pop above there, obviously if we pop above the 2018 highs, technically speaking, then the bull market continues to that point. I get that. But most markets top, they tend to have double tops. And we're not even looking at all the market cycles. It's just a bull market, but it's quite common to see a major market come in and test the top. Just like on the bottom, it often sometimes will test a low twice. But you can see there we're a little bit below there, but we're still well below the trend line. So if I was looking at this on even a 15-minute, 60-minute time frame, daily chart, and whether it was XYZ stock or an index or sector, I would say this is simply a breakdown of a primary trend line, initial leg down, kickback rally, which may or may not backtest, followed by another leg down. So we'll see. Only time will tell. But I'm doing this because if you do go down, if we do head down some point this year, and you get anywhere even close to there, just remember that consumer sentiment almost works tick for tick. It's not exactly tick for tick in the market, but you drop 5-8% correction, let's say anytime in the next month or so, you'll see consumer confidence roll down. It tends to follow that. Why? Because as I just showed you, this is the second largest component of their wealth. And we're going to now talk about the largest, which is the housing market. Okay, we're going to start here. This is not one of the major markets in the country, but it's a decent sized one. This is my hometown, Fort Myers, Florida. I'm going to start here only for the reason that I've lived through the biggest stock market, or I'm sorry, I'm going to keep saying stock market, real estate bubble in history. I believe it was, yeah, the big bubble we just had, at least here in the U.S. And it during 2008, the Wall Street Journal had repeatedly referred to Fort Myers, that whole our surrounding area, as ground zero for the housing crisis. People were flipping lots. I saw it firsthand. I was working under a regional bank in their brokerage program, but I worked closely. I was an officer of the bank, so I was working closely with the mortgage folks and everybody, and saw what was going on, and it was just crazy. So I have a little experience with bubbles, and also the stages of what happened back then. And I'll never forget, people thought prices were going to continue forever, and we were cheaper because they would cite, people come in and tell me they were going to continue to flip lots because we were still relatively undervalued compared to places like, certain areas in California and all that, where prices were crazy high, especially compared to Florida. But all right, so where I'm going with this is, I like to just draw trends. Trends work whether you're trading stocks, whether you're trading widgets, it doesn't matter. Trend is a trend, and so we're going to look at, you can see this is a long-term chart, and all these charts we're going to go over, and I'll get to some of the larger markets here in a second. We're not going to go through them all, just some of those. And you can see this is the bubble back here, and you can see, we had an uptrend and the trend broke. Now I can't draw a very good uptrend line there, but I can right here in a lot of these cities, and that's what I'm doing. So we had an uptrend. This, you remember, and let me say this: the real estate bubble back then in the cycle in the market, I don't think and I know we're not anything close to that. That was an extreme. However, this is still a cycle, so I don't expect a crash. I don't expect a redo of 2007, 2008 at all. However, I do think the cycle is turning, and I do think it's turned. I can tell you this. I'm on my third house here, my wife and I, and she's always looking to find a new house. She's always checking Zillow and all those sites. This one's Trulia, by the way, I'm using with these trends. And I'm seeing an alarming number of homes around this area that it reminds me of late 2006, early 2007. Now, what I mean by that is the bubble was building up to that point. Prices were flying up, and then what happened? We didn't just hit a peak and then all of a sudden crash. What I noticed is it took at least a good year where all of a sudden inventory just wasn't moving. People were still asking those crazy high prices because they went in, they bought a lot, or let's say because there were a lot of lot flipping here, we had a lot of undeveloped land, so they bought a lot that a few years ago went for $25,000, just a few years before that $5,000, and now they're asking $125,000, and I'm not exaggerating. That's what the typical lot flipping around here was going for. They went up many times. Or homes, same thing, similar. But what happened there was I noticed that everything just kind of stalled out. There were a lot of listings, more and more listings came online, nothing was moving. Then you see the price reductions, and I can tell you that is what I've been seeing consistently here. And again, I'm going to go through other markets because I know enough to know that what happens in one little pocket of the country Doesn't necessarily mean it's happening everywhere else, but you can look at this. This is what we're going to focus on, these trends. This is the max going back. You can see the years down here. So this was a parabolic trend, so you can't draw a trend line. You'd have to use it like that. It'd have to be a parabola when you have a parabolic trend. And then when that breaks, parabolic trends don't end well. But this is a pretty clean uptrend, and as is this, and that's what I'm seeing here. So you can see that sales prices have flattened out and they've been dropping for a while now. And you can see the number of sales are really starting to plummet. So maybe this is being talked about elsewhere, but I want to go through some of these charts. So let's just dive into a few more here. You know what, let me go back to that chart and just show you. When we zoom in a little closer, you can see 5-year. I was showing you max on the Fort Myers market first. So this is a 5-year chart. So we're zooming in a little tighter, and you can see it's just really falling off. And we're certainly in a downtrend now. A downtrend, just like in the stock market, is measured. Here, let me clean that up a little. The definition is a security or a trend making lower highs and lower lows. So make no mistake about it. And this downtrend didn't just start. It has been in play now for a while. So you can see the number of sales are really have been trending down, and now are starting to really look like they're starting to fall off a cliff somewhat. Pretty steep drop. So we're going to go through the other markets. I'll talk fast. I'll go through these fast so I can cover some markets, maybe some that you're in. But again, you can go to Trulia and find this, and maybe somewhere else. All right, so here's Boston. I'll just take my drawing tool and draw some trends. So there's your uptrend line. I'll focus on the max. If I need to zoom in, we can do that. There's your uptrend. So you can look at it this way. So far, it's been, that uptrend line's been broken right here, the uptrend, and you now have this downtrend forming right here. There's your downtrend channel. See, uptrend leading to the bubble. And remember, the crash didn't hit till '08. That's when everything melted down. The U.S. stock market topped in late '07. The real estate market peaked long before that, at least a year or more. And again, I remember it clearly that way. It just didn't go down right away because, you know why? Well, stocks are priced instantaneously. You get the news, you can go and click your mouse, get out of your Apple or buy Apple or whatever you want. Whereas homes, it's a slower roll, a much slower roll. The data comes out slower. You can't get out of your home. If you decide to sell after watching this video, you're not going to sell your house tomorrow. It's going to take you months, at least several weeks, probably months to get on them cleaned up on the market and find a buyer and then close. So that's why it's a slow roll. And you can see Boston's cracking above, well, right on trend. Boston's actually looking better than some others, but you can see there's, we zoom into a 5-year, it's starting to fall there. Let's go to the next one here. What's this? Vegas. Here's Las Vegas. A couple things that stand out. Here's where prices capped back then. Median sale price. Again, I'm still turning to look at all properties. That's 1, 2, 3, 4 bedrooms, all of them. 300,000 was the ceiling then. We're almost there now, a little lower. But you can see there was a pretty consistent uptrend. There were a few slowdowns, but at this point in time, you can see if you really zoom in, we'll have to do that on the next chart. It has finally, the trend has turned down. It didn't just stall out. You can see these were blips along the way, but we're now pointing lower. And you can see here as well, number of sales has really started to fall off a cliff and taken out a long term. It was more of a gradual uptrend there in Vegas. Here, let's look at the 5-year numbers, and then you can see it there as well. So you can see a pretty sharp drop off right there. That has clearly broken the uptrend at this point in time. So there's Vegas. Here's San Francisco. You know, everyone's pretty familiar with San Francisco. Prices just been going crazy over there. Trend line break, a back test, and clearly trending lower right now in the number of sales, and starting to, again, like everything else, just coming off a cliff. Last time I saw such a big drop, look at this drop right here. It's right here. Back late in 2008, early '09. All right, so that's the 5-year. You can see for San Francisco, you can see the sharp drop off there. Median price sales in Atlanta. Atlanta not looking well. Yeah, the trend there, the median sales price is up, and they're up quite a bit higher. And that's why I'm doing this video. Again, there's just markets are different all around the country, so you can just take it, take it as a whole, and on balance, look at all of these. But you can see there's your uptrend. It was broken there. Here's your uptrend, pretty much. You want to ignore the little spike down into the lows when everything melted down there, but you've had a pretty clear uptrend which has turned the corner, and that's a concerning drop off in my opinion right there that we have in Atlanta. That was just the 5-year there showing you go down. Seattle, near Seattle. Oh, look at strong. Look at the median sale prices go. Really nice, but the number of sales, this is concerning. So you have sales dropping off. There's your uptrend line. It's been broken. It was broken back here right around when the last bull market ended, about 2000, late 08, late 07, I should say, early 08. We've broken trend again, falling off pretty sharply. All right, next up would be, we already did Atlanta. I just did Seattle. I believe that was Seattle. Yes, that was. And now we have Phoenix. Same thing. There's your trend right there. And it looks like median sale prices are so far rolling over right about exactly where they were back at the last last peak in the last real estate bubble. And here's your uptrend to watch as far as median sale prices to go. And so this one's not looking so bad. It's moved down, but it's not falling off a cliff, nor did it get too far ahead. See, this is what the stock market's looking like. You get too far ahead, you fall harder. This is a more gradual. So I think this time around we'll see a much softer, slower grind. I think we'll see it in the market too. Not a sharp, I don't expect anything close to a meltdown like in 08, although it's possible. We saw some very impulsive selling. There was a rush for the exits. I'm still just as concerned now as I was back then, before that whole meltdown started, that we would see a rush for the exits because of the big trend towards indexing investing. And now they're making the same mistakes. Everybody's cramming back into the same index ETFs and funds and the same market leading stocks, the big FANG stocks. And again, I'm talking now about the stock market there. All right, a few more and we'll wrap it up. Here's Miami. I'm originally from Miami, a lot of friends and family there, so I know what's going on in that market. And look at that, right back to where we were back then, starting to turn down, and again the trend hasn't been as powerful as it was back then. Things were all over the place in Miami. That was a hot pocket, I should say, of the last bubble. But from here you can see, and again we're looking at the longer term trend, and it has been clearly trending down. It looks like again the common theme here is at least by number of sales, not so far in median sale prices. That's holding up, and we're at those highs now. And there's nothing to say that we can't continue on up, but we know we're getting frothy. We know where home affordability numbers are if you read about that kind of stuff. And in Miami, it's extremely low. Somebody just sent me an article the other day about the affordability, compared to the residents there. And it's at levels now might be, yeah, well, you can see it right here. The prices are about the same and incomes aren't up much then. So we're about where we were back then. And of course, we had a big drop after that in the real estate market there. All right, next one up would just be Miami. You can see it kind of breaking below this low point here. Number of sales really falling off a cliff. Median prices, again, holding up right now, but the point that I was trying to make earlier is that's stage one. And I'm seeing it here where I'm at. I'm seeing houses that are on the market. A neighbor of mine, he's buying a new house. He's moving out, and he said they dropped the house was on the market for 3 years. They've dropped $2 million on the same house in 3 years, and then now it's finally moving. And I'm seeing many other homes like that have been on the market. They're asking, top dollar, or what they, what the way that everything was trending, but they weren't moving. A couple years ago, you were seeing things move a lot quicker. It hit the market, things go at or near asking price. Now, all I'm seeing across the board, rate reductions, and I'm talking about Zillow and those other services. All right, so there it is, Miami. Orlando, Florida, right back to where we were back in 07 at the peak. And their trend, they get pretty frothy then, big correction there. Again, the saving grace here is that we didn't have a bubble this time around, at least not such a fast rise. But as far as again where we're at with the valuations, that's putting a ceiling, and we're already seeing things roll over when you look closely. Here, we'll go to the next chart, the 5-year. You can see the trend is starting to roll over. Is it a blip? And we go higher? Maybe. Just something to watch. That's why I'm doing this video. You guys can monitor this stuff as well. But remember, if this trend continues, if you see houses, you're seeing the same thing, more and more listings going up, not moving, price drops, the next phase is then everybody realizes, okay, top is in. You have more and more inventory flooding the market, and that causes prices to drop, and therefore consumer confidence drops. So here's LA. You can see LA, pretty much falling off a cliff lately in number of sales. You had a little uptrend there, and then things kind of flattened out. I would say probably a more significant level is this level here, and we're dropping there. There's your trend for median sale prices, which has been uptrending, but we're coming up on that uptrend now. Here we can see it a little closer there. So that's the concerning thing, the number of sales dropping off there. Denver I know has been a hot market for a while now, really hot market. And look at the prices. Denver's way above their bubble. 2007, the last real estate, almost twice. That's crazy. And I know that to be true. I know people that have looked at homes there. I know people that live there. So that one's kind of unique in that sense. But again, how long is a market going to tolerate a double in home prices, average median home prices in just 10 years? And you can see what's been going on there. Well, prices haven't really collapsed. They're not going up lately, but they're still in that trend. They're at that trend line, but they're moving down. The trend is now lower, just as the trend was lower back here in number of sales. That's Denver 5-year. Here's Tampa, Florida. Tampa's clearly broken below trend, and I think I'll wrap it up here. I can go on and on. I do have some more to cover, but it's more of the same, and you get the point. So watch these trends. There's your trend right there. Trend broke. We're on trend now, except this comes first. You see the sales drop off. The number of sales, there aren't as many deals closing. A lot more inventory coming on the market, and prices are dropping. And then this comes next. When you had your home on the market for a year, 2 years, you need to sell, you're going to lower your price. So that's what we're looking at. And if I see anything big on this, maybe we'll do an update. But again, this is macro fundamental stuff, and it's not going to change anytime today to tomorrow. A lot of these reports they're only reported monthly, looks like semi-annual, on these numbers here, at least on the max there. Yeah, and the 5-year as well. So, yep. Okay, so we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.